Don't worry. This is one thing people don't understand. Stop trying to get the tightest stop losses. Trust in a higher time frame. Get in the market and relax. That's simple, right? We can't necessarily enter in here. So the way you know is I'm gonna show y'all a trick really quick. I'm gonna show y'all a trick. All right. Entering and exiting the market has been the biggest question that I get on a day-to-day basis. And in today's video, we are going to break down how to properly enter and exit the market with precision. And make sure you stay to the end of the video because I have a secret that I'm going to show you on how to catch high RR trades, 5, 10, 15, and maybe even 20 extra money in these markets. So let's get straight into it. If you are new, my name is Divine. I am a six-figure funded trader with Top Step on my way to make my first six figures in the market. And in today's video, we are going to break down entries and exits because I do get a ton of questions of how to enter, when to enter, how do you know? My favorite three things, as you know, is sweep of liquidity, supply and demand, and time. And we're going to break down those three things, but I'm going to show you pair examples, get straight into it. And right now, we're going to start off with golden rules of all of it. So let's get straight into it. And I'll see y'all on the other side. All right, guys. So we're going to make this intro very short because I want to show you guys real life examples. As you can see on my chart, the main thing is these few golden rules, and I didn't just pull these out my ass. These are literally what you need to follow. And when you're talking about entry and exit, you always want to take the low-hanging fruit, meaning a lot of people want to take 1 to 5s, 1 to 3, 1 to 2. No. Where do you, based on where you're entering the market, which I'm going to show you, and based on where you think it's going to go, where's that low-hanging fruit point where you know market could go? You either can exit all positions there or take 90% profits, and then you might have that stretch target of whatever it is, and you can let price run to that point or break you out even in profit or at break even, right? So always take the low hanging fruit. Something I learned from ICT. I'm going to show you guys as well and teach you guys that as well. Just take the low hanging fruit. Don't be greedy. It's very hard, but don't be greedy. Next thing is don't get pretty. We want to take the prettiest setups and make them look beautiful so we can share them. That is unimportant. Take the setup and take it with confidence. It doesn't have to look how everyone needs to look. It doesn't have to have a textbook look. The way that I'm going to show you will not always look that way, as you will see as well. So always just don't get pretty and try to make it look how you want. And because it's not the way you want it to look, you just don't take the trade. If it is your setup that I'm going to show you, take the trade. And that gets us into the next one is just take the trade. We often have price here or there. We want to anticipate or try to predict what the market is going to do next. Get rid of that shit. Do not predict the market ever. Literally just when you see it, get in, observe the market. Once the setup presents itself, get in the market, take the trade, keep it very simple. The most important thing, and shout out to my guy who put a comment, I'll put his comment here or somewhere in the video. Do not, when you get in a trade and you know that it's the right trade, I know it's hard to when you especially when you're going on a losing streak, because I've actually been dealing with this past week where I'll have a trade here and a trade there. Win, loss, right? Because the market is very choppy. But then often I found myself getting in trades, and then as soon as it came against me a little bit, I will have an issue, right? Don't do that. And I always have to dial myself back. So if you have to take a session off or you have to really go right down in your journal, whatever it is, do not do that because when you get in a trade and you try to force on with the market gonna give you exactly what you feeling, right? Just let the trade play out, give it some space, lower your risk so you can see it through. Whether you win or lose, it doesn't matter. Take the trade because it is your setup. And then the last thing we always want to do is just observe the market. Do not predict the market. Understand that we can't predict the market. We don't know where it's going. We don't know how it's getting there. Just understand that we need to get in our setup, set our alerts, whether win or loss, we just let price get to where it's gonna go. Those are the golden rules. Low hanging fruit, don't get pretty, take the motherfucking trade. You know what I'm saying? Just take the trade, accept the risk, and observe the market. Do not be a predictor of the market, be an observer of the market. Relax, we cannot control it. It is an algorithm, it is manipulated banks, whatever it is, we cannot control it. So just observe and let it happen. So let's get straight into our model and what that's gonna look like for you and break everything down. So if we're looking at our model, and what's important with our model is it's again, like I said, it's never going to show up the same way as we always think it's going to show. But essentially what we got here is we have bearish price action. And if we look at this leg single-handedly, I'm going to make this quick as possible. Actually, let me know in the comments right now, really quick, what time frame you guys trade, whether it's the 15, 1 minute, 1 hour. I trade the 1 hour, sometimes the 15, but mainly the 1 hour, 4 hour daily. Let me know in the comments what you guys trade so I can start to bring you more and better videos because I really want to know what's going on. That way I can help you the best way I can. what we see here is on this leg, we have bearish price action, lower high, lower low, lower high, lower low, lower high, lower low. Simple. But along that leg, what we love to see is liquidity being built up. If you haven't seen my liquidity video, go check it out. It's very simple, very short. It is golden because it said, hey, double tops, trend line liquidity. These are points that the market will. So when we're actually going in the opposite direction, these levels are manufactured so we can actually just push up and have liquidity when we're going in that direction. Now, this is being manufactured liquidity. When we look here, we have a nice lower low, lower high, lower low. And then we immediately take that lower high and make a higher high. And then after that higher high, we take and make another higher high. I'm starting to see a shift in market structure and a shift in overall everything. So if we were bullish long term and we hit a say a daily level here, let's say we hit a daily level here of demand, we understand that we want to see that shift. That first level of supply, we want to see that break. Once that breaks, I'm looking to enter, but this is the risky entry. If you want to be a lot more conscious of what you're doing, you want to let that second break go, and then you understand, hey, I have liquidity to target in the market. This is a low, a weak high because it couldn't take out the low that would be down here that created this move to the upside. So this level is liquidity. These are liquidities. This is liquidity. Liquidity moves the market. So in order for you to know direction in the market, you just need to understand liquidity, map it with market structure, supply and demand, and you got a full-blown strategy. So we would enter in this point, and even this point, usually after that 1, 2, 3 mitigation, which I may show you, the market is gone. It's not coming back. So you want to understand, like, hey, couple reasons why this is going to the upside, couple reasons why we could take this entry. One, we are bullish long term. So this is a higher high, higher low, higher high, right? We have a weak high up here liquidity. We have a double top liquidity. We have trend line liquidity. We also just had a market shift. We had a break of supply, and then we had another break of weak supply. Let's see if price is going to go to the upside. All we do is look for a nice demand zone that swept liquidity, broke the supply or demand, and then we enter the market. And that's what I'm going to show you. And the same thing on this side, we want to see that fabrication of we want to see that fabrication of this liquidity, right? So double lows, we double bottom, we got a relatively equal bottom or trend line liquidity here. We break that first level of demand, we come up first risk entry, this more of a confirmation entry. And then as you can see, even sometimes as we're market is allowing us to enter the market, won't even create liquidity on the way down. So it'll stop, come here, don't take the low, come back, get more sellers in, get more buyers in the market, and then take everybody out. Then test that level one more time, and then we off to the races to the bottom, and we targeting all of this level here. So this is what it would look like overall. This is our motto in a sense. Now, does it always look like this? No. But I'm going to give you a few examples right now, explain everything, what we targeting, and really give you real life examples. Now, when I give you these examples, what I want you to do is to go into your own charts this weekend, go into your own charts and find this all over the place. Get as many screenshots as you can, save them in your journal, put them in a Discord, Notion, whatever it is, collect data, and just make sure you can see it clearly because it's going to always show. And then you'll be a master at entering the market. So let's go straight to the 1 hour and we're going to find some entries for y'all on a bunch of different pairs. That way, you know it works in every single market. So when we're looking at this and when we talk about our entry model, it's very simple. Now, we've already seen what happened because I don't want to have you sitting on the video all day. I really want you to just go do this. So bear with me, but I got y'all. I'm gonna get y'all out of here. So when we're looking for this model, we want to see a low being taken and we want to see a high being taken. We want to be at a key level on the daily time frame or in a 4 hour or even sometimes a 1 hour. We just want to have some sort of demand chain. When I say demand chain, well, when you think about market structure, right? Price gives you a demand chain first and then it end up flying away, something like this. So either you have a 4 hour level, daily level, or you have a 1 hour demand chain that you're following. That way you can enter the market and get in. So as you can see here, we have a point where we have a low. Here, we end up taking the high, which was liquidity. So realistically, we could say if we looked at this again, we'll say, well, this is our high, this is our low, lower high, lower low, right? Well, we would technically need to take out this level. But what happened here was what a lot of people overlook is we had this key level here. When we made this low, we made this, we made this, we made this, then we took a low, we took a high. As you can see, this is like a V shape. When you see that V shape, something just shifted. We get that first break. If we are aligned, if we look to the left, I'm pretty sure it's some level of demand or something that we tapped into with liquidity. Maybe something here and this level here. Let's drag that over, and we got some lows in here that we potentially swept. I'm pretty sure. Yep. And then we drag this over. So when we look at this area, we say, hey, listen, we tagged some lows, we swept this area, we tapped into a level that's clean. Once we get this break, we got our sweep because what? We got a low swept here. We also have these lows swept here. We also have our first break of supply showing, hey, listen, this was a level that created a low in the market. This level broke immediately. And it was tested. As you can see, these wicks in here, it was tested. So it was clean. It was a viable level that we like. We drag out our demand zone and we just say, hey, listen, I'm looking to enter here. I'm just going to wait for time to align. Once time align, that is, if you're in New York, I'm going to just do New York times, 7:30, 8 o'clock. I'll say 7:30 to 11 o'clock a.m. Eastern Standard Time is key time because that volume in the market. Sometimes it goes early, but sometimes that 8:30 to 9:30, that's where you're looking to enter the most, or 8:30 to 10. So when we look at the price hitting this level, it hits this level at 5 a.m., 6, 7, 8, and then we end up coming back to this level around 11 o'clock. Me, I'm going to enter on that candle because I like it. I'll put my stops here. And the reason that you could put your stops a little closer is because, as you can see, what did we get? Look at our model. We got low swept, and then we got a V shape, and then we took the highs, right? We see some displacement in the market. Well, what happened here, if we zoom in, is also the same thing. We got a high, we took a low, we got a V shape recovery, right? We took out all the supply to the left, and then we have displacement, meaning it's just strong candles with imbalance to the upside. We come back to that level and respect the low. So some people, I used to trade this way, but I would enter here, or I would enter on this imbalance here. I will put my stops here. And then you can target the liquidity. Now, is liquidity rested everywhere, where the first level of liquidity was here. We have a ton of liquidity rested in this area. So that's a key thing. This is a level in the middle of this range from high to low. So this is liquidity, because if we took this here to this low, this level is right at the 50%. So that is a free entry to take out those highs. And then we also have imbalance and stuff up there. And this is a weak high. We know it's a weak high, and we can target that. So that is a form of an entry where we can get in the market. Because we had that first break sweep, we took out level supply, and then we even got it on a lower scale. And then we were able to get in even more so. And then what did I tell you? The market will give you one, two, maybe three opportunities to continue with that trend, get in, and then it's off to the races. And as you see here, we get a break up, right? And this was a key level here. We take our maybe the range because it's a range of demand. Don't worry. This is one thing people don't understand. Stop trying to get the tightest stop losses. Trust in a higher time frame. Get in the market and relax. That's simple, right? Here, put our stops here, but wait, we want to wait for time, right? Well, we got 4 o'clock London session, 5 o'clock, 6, 7, 8, 8 o'clock. We hit this level, key level. Remember what I said? Sometimes time will just sit there and then wait for you patiently. You won't get in, and then it just go. So in this case, me, I'm getting in the market. I know that time is on my side. I'm gonna get in. So that's one entry, potential 1 to 5, right? This is on an hour time frame. That is beautiful. You might have to wait a day or two, but it's beautiful. Also, we get opportunities here. Well, this starts to pull back. We can't necessarily enter in here. So the way you know is, I'm gonna show y'all a trick really quick. I'm gonna show y'all a trick. All right. So if you don't know where to get in the market, what you want to do is, when you see price start to kick in supply, map out that supply, right? So you want to see where that supply is at. So you see that we basically got some sort of like small supply chain. We got here, we come up here, and then when this key level here is what took the low. You see this level of supply right here? Took the low. Once that supply step in, you need to break that supply, and then you have a level of demand that just entered the market. You always want to look to the left also. So we say, hey, this level just broke demand and reacted from this supply, but this is the most recent that made the low. So you look, you take this level, and you say, hey, what did we just react off? You want to validate it. Cool. Well, we reacted off a supply demand flip because we got a break down here. We break above that, we test it, make a new high. We come back, test it again, and we potentially can make a new high. So you got to be confident if it aligns with time. Well, this level also did another thing. It swept these lows, right? Remember, we got our sweep of liquidity, our break, come back. We got our sweep of liquidity, we got our break, we come back to our level, right? 2, 3, 4, 5. London session action right here. 7 o'clock, we still there. 8 o'clock, whatever it is. We get in the market. We rest our stops down here and we say, hey, listen, I'm just gonna get in. I don't know what's gonna happen, but I'm following my plan. I'm following what I know. I'm following what I collected data on. So does that mean I'm gonna be 100% correct? No, it means that I'm following my structure and I have a reason to believe that price is gonna go up there. Let's look for that liquidity that price manufactures as we're going up. Well, look, liquidity right here to go tagger it, right? Old highs. We couldn't take out lows, right? Target liquidity. Understand this is what the market gives us. So that is how you will enter the market. Very, very simple. We're going to go to GBP USD and show you two more examples. I'm going to break them down really quick and I'm going to get you out of here. All right. All right, guys. So second example. So again, we want to see a trending market. One, we want to make sure we align with higher time frame levels and we want to get that sweep displacement, make sure time is aligned, breaking supply and demand, and then map it all out. So again, what we got here is we have, again, what did I tell you? Well, we have a level here that did what? It swept this beautiful low and these beautiful lows. Key. Why do we know this is a sweep of liquidity? Not just because it's a wick and then go. It's a wick and then we do what? We immediately make that V-shaped recovery that we talked about, right? And we take out this recent level of supply. We even take out these levels. These levels were also what? Liquidity, right? Trendline liquidity that we talked about in the past. So we know that this level is a key level. And if we take this level and we drag it out, maybe, right, like this, we can say, all right, cool. Let's validate what we tap into a nice imbalance here. On the higher time frame, if this was a daily level, this will probably be a strong candle that we just reacted from because this entire level is very, very important. We could just say that's a daily level. I know that because I know how to read the daily from a lower time frame. So this level is key. So we didn't just sweep liquidity. We swept liquidity, tagged the daily level. We're trending pro trend. We took out liquidity and we had a displacement to the upside. We want to drag that over. Now, what's going to tell us to enter the market? Well, remember when I said we know we have a demand chain that's showing us to get in the market? Well, this is what I meant. If we drag this over, like I said, we have some sort of like level here of demand that we just talked about. So now we got 1, 2, 3. Now, depending on when price gets to this level, we can enter the market. So for example, if you trade London session, feel free to take this trade. This is a clean trade. Don't be afraid. Let this level, because the reason we look for sweeps of liquidity is because that low should be protected. Now the market can switch trends shift and then take that low, and then we know we go the opposite way potentially. But this is why we have the demand chain, because you have a chain that's respected. You have liquidity that is being respected. You have a low that is being protected now. You got all these things that's lined up showing, hey, take this trade. So if you take that trade, you have a level here, you have a level here to target, and beautiful, beautiful trade. Now in New York, which is my time, we would have to get in up here and stuff. Well, no, let's just be patient. Let's wait for price to do something. Well, this will be our level right here. Price creates a move in the market. We create an even higher move, an even higher move. Well, now I'm starting to see the price manufacture some things. So we come here and we see, hey, we got some liquidity here. We have a weak high here. This high is weak because it could not take out this low down here. The job of this low is to take out this high. The job of this high is to take out this low. When you can't do that, you get swept and you become liquidity. So we just map this out. This is our level. And we say, hey, listen, what time can I get in the market? Okay, well, here, 7 o'clock, 7:30. If I see price tag this level and swept this level, which I like to see, the reason why we wouldn't take this, even though it made a new high, is inducement. But that's another thing. If we drag out this right here, we have inducement. We take the lows. So if you want to know what inducement is and you want to understand how to trade that, let me know in the comments right now. Just type inducement and I'll make a video on it. But we take that inducement. Again, London session, you guys got lucky here. Take the entry. Beautiful target, beautiful target. If you in New York session, you're not chasing price. Just get in the market and have a bigger stop loss. 7 o'clock, 7:30. Put your price here if you believe price is going to hold, or put it here. And then just target your liquidity and understand that that is a clean trade. Also, maybe price, so let's say price came up here and then it pulled back a little bit, swept you. You'll still be protected, but you know where you're going because this is a protected low as well now. So this is a simple way of entering the market, utilizing liquidity, trending markets. Let's go over one more example and then I'm gonna get you guys out of here. And this, if you hear at the end of the video, if you hear right now, don't go yet. Because I'm telling you, this next one, it's the same thing, but you get a higher IRR. I was actually in this trade and I under risk like crazy just to see what was gonna happen, honestly. So let's get straight into it, man. All right, guys. So our last segment, really quick. So I wanted to show y'all because this is the same thing that happens on the 1 hour happens on the 1 minute. So if we go to our 1 minute and we look in at this section here. So, and when I was trading this day, I was just being patient. Hey, we didn't take Asia highs, which I don't like, but potentially we could be on our way down or just go to the extreme down here and then take the highs, which I believe was going to happen. Hence why I was going to ping pong price, but that wasn't the case. And essentially what happened here is we had a high created, and this high ended up doing what? Manufacturing liquidity in the market. Okay, meaning all these levels here was equal lows, triple bottoms, but double bottoms, whatever it is, and we respected that. Then remember what I said? Hey, if you don't know where to get in at, just wait for price to wait. Remember I said wait for the supply to enter the market and then let demand break that supply and then enter. Well, the same thing here. We don't know where to enter from ourselves at here. We don't have a key level. So wait for demand to enter the market, right? Wait for demand to enter the market. Oh, we get a sweep right here. And how do we know this was a sweep? Because if we map this out, we do what? We have our V shape. We take a high, take a low. Beautiful, right? If you drag over what we tagged into, well, we just tapped into a nice flip supply zone. So I'm like, yo, this is a high quality like level of what I'm looking at. Like I used to trade this a lot. Let me see what's gonna happen. Price plays around. We get up here. Look at time down there, 9:03. Take the trade. We take the trade. Jesus, come on now. Let's not do this. We take the trade. We put our stops right here. Actually, did I put? I think I gave my a little bit of room. I always do, especially on the 1 minute. And then my only target was here, right? Let's see where we at. Right here. Cool. Well, then I seen a demand zone down here, and I said, all right, maybe we could get to this level here, like this range of demand. Because we have what? Liquidity. So this is Asia low liquidity. We also have liquidity here. So I believe price would take out this little trend line liquidity and then come tag into something down here. And what happened was I was in a trade here. Price started reacting. I tried to get him buys real quick too. And then price took me out immediately, which was fine. So again, I'm like, well, I'm gonna just catch more sales. So this was again our sweep, our break, enter the market with time aligned. Also, we have our chain forming of supply. Now here, same exact thing. I figured it out again. I'm like, listen, all right, where's our demand zone? Because we want to supply demand flip. We drag this over. Cool. I know that. What's aligned with that level? Well, if price demand stepped in the market, map it out. Demand steps in the market. We come up here, we break that level. All I need to do is drag over that level, mix with whatever my imbalance, and then I have another opportunity to enter the market. And actually, some news came out at this time. I put my stops here, and then it was a daily level that was to be target. It was something like round here, like that. And it's the same exact thing all the way down the chain. So this is how you would enter the market. If you want me to go more in depth on this, let me know in the comments, and I'll make a even longer video breaking this down because it's order flow that I need to teach you guys, a lot of different stuff that'll help you understand, hey, price shouldn't go above this level right now because it should be respecting order flow, especially with the amount of volume, blah, blah, blah. So that's all I got for y'all today. But if you enjoyed this video and you want to see more of it, let me know down in the comments. And if you want to learn more about Liquidio, and if you want to learn more about liquidity, check this video out right here, and I'll see y'all later.